Have you ever seen a business that looked like it was thriving, growing revenue, healthy profits on paper, only to suddenly disappear? It's a perplexing, even frightening scenario for any entrepreneur. This isn't just a cautionary tale. It's a critical lesson in business survival. In this video, we're pulling back the curtain on one of the most misunderstood aspects of business finance, the crucial difference between profit and cash flow. We'll explore why profit alone doesn't guarantee safety, why timing is everything, and how even rapid growth can become a silent killer. If you've ever felt that underlying fragility in your seemingly successful venture, this episode is your guide to building true financial resilience. Welcome back to The Profitable Owner, where we empower entrepreneurs like you to master the financial heartbeat of your business. Our mission is to demystify business finance, transforming complex concepts into clear, actionable insights. We want you to make calmer, smarter decisions, free from fear and guesswork. In our previous episodes, we explored why many profitable businesses still feel uneasy and how inconsistent owner pay can lead to stress and poor choices. Today, we dive deep into the lifeblood of your business, cash flow. Specifically, we'll dissect the critical distinction between profit and the timing of your money. By the end of this session, you will gain a profound understanding of why profit does not equal safety. You'll learn how timing problems can quietly undermine even the best businesses and why growth often exacerbates cash flow issues rather than solving them. Most importantly, you'll discover how to approach cash flow with a realistic, empowering mindset. This isn't about complex accounting jargon or abstract financial advice. This is about equipping you with a clear understanding of your business's financial reality. It's about giving you the tools to make informed decisions that drive sustainable growth and long-term stability. Many entrepreneurs operate under a deeply ingrained, yet dangerously misleading, belief. If my business is profitable, it must be safe. This sentiment feels logical, almost intuitive. After all, profit signifies that your business is generating more revenue than it spends. While profit is undeniably vital for long-term sustainability and wealth creation, it's a lagging indicator. In the short and medium term, profit alone is not the ultimate guarantor of your business's survival. This is a critical distinction for every founder to grasp. Businesses don't typically fail because they are unprofitable on paper. They fail because they run out of usable cash at the wrong time. This fundamental truth often comes as a shock, especially when the profit and loss statement looks healthy. Accepting this reality can be challenging because profit feels like the ultimate measure of success. It's what investors look for, what banks consider, and what often validates your hard work. Cash flow, on the other hand, often feels mundane, a tedious detail, until its absence threatens everything you've built. Let's simplify these two core concepts to highlight their fundamental differences. Profit answers a historical question. Did the business make more than it spent over a specific period? It's an accounting calculation, a retrospective look at financial performance. Cash flow, however, addresses a very different and far more immediate question. Did the money arrive before it was needed to cover expenses? This is about liquidity, about the actual movement of funds in and out of your bank account. You can absolutely answer yes to the profit question and still face a catastrophic no to the cash flow question. This disconnect arises from timing mismatches, which are incredibly common in the entrepreneurial journey. Expenses, such as payroll, rent, and supplier payments, are often immediate and non-negotiable. They demand cash now. Revenue, conversely, is frequently delayed. Think about invoicing clients with 30, 60, or even 90-day payment terms. You've delivered the service or product, earned the profit, but the actual cash is still outstanding. This gap between earning and receiving is where cash flow problems begin. Furthermore, growth itself often exacerbates these timing issues. As your business expands, it typically requires more upfront investment in inventory, marketing, or staffing. These increased expenses hit your bank account long before the corresponding revenue from new sales materializes. Understanding this dynamic is crucial for effective business planning and financial analysis. The demise of a business rarely happens with a sudden, dramatic collapse. More often, it's a slow, agonizing suffocation, a gradual erosion of financial stability. These businesses often appear successful on the surface, masking the underlying cash flow crisis. The warning signs of impending cash flow issues are often subtle, easily dismissed by busy founders. You might find yourself constantly checking your bank balance, experiencing a fleeting sense of relief when a large payment finally arrives. This indicates a reactive, rather than proactive, approach to your finances. Other red flags include stretching payables, delaying payments to suppliers, or negotiating extended terms out of necessity rather than strategy. You might also find yourself consistently delaying your own owner pay, sacrificing your personal financial stability for the business. This is a common, yet dangerous, coping mechanism. Emotionally, you might feel like you're living month to month, constantly on edge about upcoming expenses. On paper, your profit and loss statement might still show a healthy profit, creating a false sense of security. However, in practice, your business is operating without any margin for error, one unexpected expense away from crisis. Cash flow problems rarely announce themselves with a loud, clear alarm. They begin as whispers, subtle anxieties that grow louder over time. Ignoring these whispers is a critical mistake in risk management, as they are early indicators of deeper systemic issues that require immediate attention and problem solving. Growth is universally celebrated as a sign of success and progress. More revenue, more customers, more market share. These are the metrics entrepreneurs strive for. However, growth is also one of the most misunderstood and dangerous risks in business, especially concerning cash flow. Rapid growth often demands significant upfront investment. You might need to purchase more inventory to meet increased demand, hire additional staff to handle new projects, or invest in new equipment or marketing campaigns. These are all substantial expenses that hit your bank account immediately. The revenue generated by this growth, however, typically arrives much later. There's a lag between the investment required for growth and the cash collected from new sales. This creates a cash crunch where your expenses outpace your incoming funds, even if your sales figures are soaring. This phenomenon explains why many owners lament, "My business grew, but I felt more stressed than ever." The increased revenue brings increased complexity and larger financial commitments, often before the cash flow stabilizes. It's a classic case of growing broke. Growth does not fix weak cash flow systems, it magnifies them. If your business already struggles with timing mismatches or inefficient cash management, rapid expansion will only exacerbate these issues. Effective growth strategy must always be paired with robust financial analysis and proactive cash flow planning to ensure sustainability. Entrepreneurs, by nature, are optimists. This mindset is essential for starting and growing a business, but it can also lead to misreading critical financial risks, particularly concerning cash flow. Several cognitive biases contribute to this oversight. One common pitfall is relying solely on the current bank balance. "The bank balance looks fine, for now," is a dangerous thought. It provides a snapshot of the present, but offers no insight into future obligations or incoming funds. This creates a false sense of security, ignoring the forward-looking nature of cash flow. Another factor is the confidence derived from recent revenue success. A string of good sales can lead to the belief that the good times will continue indefinitely, masking potential future shortfalls. Past success, while validating, does not automatically protect against future cash flow challenges. Founders often believe that their past achievements or current profitability will somehow shield them from liquidity issues. This can lead to complacency, delaying the implementation of crucial cash flow management strategies. It's a form of survivorship bias, where past good fortune is assumed to be a predictor of future immunity. Businesses don't need financial perfection to thrive. What they truly need is room to breathe, a buffer of cash that allows them to absorb unexpected expenses, manage payment delays, and invest in future opportunities without panic. Understanding and mitigating these biases is a key aspect of effective risk management and problem solving. Unlike the adrenaline rush of closing a big sale or the satisfaction of seeing a profitable P&L, healthy cash flow isn't exciting. In fact, it often feels boring, and that's precisely the point. It's the quiet hum of a well-oiled machine, not the frantic sputtering of an engine running on fumes. In a business with healthy cash flow, predictability replaces panic. Owner pay becomes consistent and reliable, allowing you to plan your personal finances without stress. Expenses are planned for and covered, eliminating the constant worry about upcoming bills. Unexpected events, which are inevitable in business, become survivable rather than catastrophic. A healthy cash buffer means a sudden equipment repair or a delayed client payment won't derail your operations. Decisions are made from a place of calm strategic thinking, not reactive desperation. Cash flow management isn't about squeezing every last dollar or hoarding cash unnecessarily. It's about reducing fragility and building resilience into your business model. It's about creating a financial foundation that can withstand the inevitable bumps and challenges of entrepreneurship. A business with stable, predictable cash flow can absorb mistakes, pivot when necessary, and invest in growth opportunities with confidence. A profitable business without this stability, however, remains perpetually vulnerable, always one timing mismatch away from crisis. This is the essence of empowering financial analysis and robust business planning. This brings us full circle to our core message from episode 1. Profitability is a condition, not merely a number on a report. A truly profitable business is one that not only generates a healthy profit, but also effectively manages its cash flow. It's a holistic state of financial well-being. A truly profitable and sustainable business consistently generates profit, demonstrating its ability to create value. Crucially, it also masters the art of timing, ensuring that cash is available when needed, bridging the gap between revenue earned and cash received. This proactive management prevents liquidity crises. Such a business consistently pays its owner a fair and predictable salary, acknowledging the value of the entrepreneur's contribution. Finally, it builds robust cash buffers and reserves, creating a safety net that allows for strategic investment and resilience against unforeseen challenges. When profit and cash flow work in harmony, the stress levels for the owner dramatically decrease. Decisions become clearer, more strategic, and less reactive. The business transforms into a durable, resilient entity, capable of sustained growth and long-term success. This integrated approach is the cornerstone of effective growth strategy and problem solving. If you've ever wondered why a business that should be doing fine still feels risky, now you know why. Cash flow is not a minor detail. It is the fundamental difference between survival and failure, between constant stress and calm, strategic growth. It's the lifeblood that keeps your profitable business alive. In our next episode, we're going to delve deeper into the paradox of growth, exploring why it often makes business owners' lives worse before it makes them better. We'll equip you with practical strategies to approach growth more realistically, ensuring it serves your business's long-term health, not just its top line. Don't let your profitable business become another statistic due to poor cash flow. It's time to move beyond just tracking profit and start actively managing your cash. We've created a free, downloadable cash flow health checklist designed specifically for founders like you. This practical tool will help you identify potential timing mismatches, assess your current cash position, and pinpoint areas for improvement. Click the link in the description below to download your cash flow health checklist now. Start building the financial resilience your business deserves. And if this video has empowered you with new insights, please like it and subscribe to The Profitable Owner for more actionable strategies. Your engagement helps us reach more entrepreneurs who need this vital information. Thank you for watching, and here's to your truly profitable and resilient business.